Your paycheck hits your account on Wednesday, just like it always does. Rent is scheduled to pull on Friday. Groceries, utilities, your car payment, every bill lined up exactly the way you planned. But this time, something's different. The deposit shows up, and then it doesn't. Instead, you see a notice. Funds on hold, pending review. No warning, no explanation, just your own money temporarily frozen because the system flagged it as unusual. And here's the part almost nobody is talking about. This can now happen even if you did absolutely nothing wrong. In 2026, a new banking rule quietly approved behind the scenes is changing how banks monitor your account. Not just the money going out, but the money coming in. Your paycheck, your tax refund, a transfer from a family member, all of it is now subject to deeper automated scrutiny. The goal is to protect you from increasingly sophisticated fraud. The side effect? Legitimate transactions can get caught in the crossfire. One unexpected bonus, one new payment source, one deposit that looks different from your usual pattern. Sometimes that's all it takes for your account to be flagged for review. If you rely on direct deposit, autopay, or government benefits, this affects you. If you assume your paycheck will always clear instantly, this affects you. If you think fraud only happens to other people, what's coming next might surprise you because the speed of money itself is changing. Payments now move in seconds 24/7, which means fraud can happen in seconds too. And when money moves that fast, banks respond by tightening the filters. The real question isn't just, is the system getting safer? It's, do you understand how it works before it affects your account? Because here's what banks are not explaining clearly. The same technology that protects you can also temporarily block you. And if your rent is due, or your mortgage autodrafts overnight, even a short delay in one deposit can create a domino effect. Declined payments, overdraft fees, late fees, credit score, impact. Most people won't see this coming. By the end of this video, you will. You'll know exactly what changed, why it changed, and what to do so your own money doesn't get stuck in limbo. Hi, I'm Sofia, and you're watching Borderless Pathways. On this channel, we break down financial rule changes in plain English so you can stay ahead of them instead of reacting after something goes wrong. Banking updates rarely make headlines, and when they do, they're usually not explained in a way normal people can actually use. But in 2026, several major shifts are happening at the same time, and together they reshape how your bank handles your money. Today, you're going to learn what rules were approved, what's rolling out this year, how it affects your direct deposits, autopay, fraud protections, benefits, overdraft fees, and even how fast money moves between banks. Some of these changes genuinely help you. Others mean you have to pay more attention than you're used to. The goal here is not fear. The goal is preparation. Let's start with the big picture, then zoom in on what you should actually do differently, why your account is being watched more closely. To understand the 2026 rule, you need to know what's been happening quietly in the background over the last few years. The way money moves in America has changed. We've gone from a system that processed payments in slow batches during business hours to a system that increasingly runs in real time, 24 hours a day, 7 days a week. That speed is convenient, it's powerful, and it's risky. Fraud today doesn't look like it did 10 years ago. It's not just someone stealing your card and buying a TV. Criminal networks now use stolen identities and data breaches, exploit online payment systems and apps, launder money through innocent people's accounts, use AI and social engineering to trick people into sending money themselves. They don't always just pull money out of your account. Sometimes they push fraudulent deposits into accounts, create fake credits that later reverse route funds through multiple accounts in minutes. And once money moves instantly, getting it back becomes dramatically harder. This is where NACHA comes in. NACHA is the organization that governs the ACH network, the system behind direct deposit paychecks, government benefits, mortgage drafts, utility, and subscription autopay. Most recurring transfers in and out of your account. If you get paid by direct deposit, you're using ACH. If your car payment is drafted automatically, that's ACH. For years, banks focused most of their fraud detection on outgoing transactions, money leaving your account. If a strange debit showed up, that was the red flag. criminals adapted. They started manipulating incoming funds instead. So regulators and payment networks came to a simple conclusion. Watching only money going out is no longer enough. That realization led to the 2026 rule change. Banks are now required to monitor both debits and credits more aggressively. Every direct deposit, every refund, every incoming transfer, all of it is now run through expanded risk analysis. The systems look at patterns, frequency, amounts, sources, timing your past behavior, and then assign a risk score in milliseconds. That's where it starts to touch your everyday life, how a normal payday can trigger a hold. Imagine your usual pattern. You're paid every other Friday from the same employer, roughly the same amount. The system learns that pattern and treats it as normal. Now picture a change. Your employer issues a surprise midweek bonus, or you work a lot of overtime and your check is much bigger than usual, or your payroll provider changes, and the description looks slightly different to you. That's good news. To an algorithm, that's an anomaly. Anomalies trigger review. Sometimes the system clears it instantly. Sometimes, especially when multiple unusual factors line up, the deposit can be temporarily held while it's verified. Not because you did something wrong, not because your employer did something wrong. Because under the new rules, the system is designed to slow down things that don't fit the pattern. Now combine that with timing. If that hold happens the same week your rent or mortgage autopay pulls, your account might not show that incoming money yet, even though it's on the way. Result, a declined payment or a negative balance or an overdraft fee, depending on your settings. From your point of view, the money is yours. From the bank's perspective, they're now required to verify before releasing it fully. And it's not just payroll. Tax refunds are often the largest single deposit some people get all year. They're also a major fraud target. One-time transfers from family members or buyers, if you sell something online, can look different from your usual activity. Gig workers and side hustle earners often have irregular income from many sources, patterns that are naturally harder for algorithms to classify as safe. The key idea, the more predictable your account history, the easier it is for systems to separate normal from suspicious. The more variable it is, the more often it may be reviewed. Now, before that sounds completely negative, there is a real upside. Why this can actually protect you. This rule was not created just to annoy you. Fraud losses across the financial system have exploded. Banks are under pressure to prevent unauthorized transactions, stop account takeovers, reduce their own losses, protect customers from being pulled into scams and money laundering. Monitoring both incoming and outgoing funds can stop fraudulent deposits from ever becoming spendable, can keep your account from being used as a pass-through in a larger criminal scheme, can block altered or fake checks before they appear as available money in your balance. So yes, the system is stricter, but it's also smarter. Under the old model, fraud detection was often reactive. Something posts, you notice it, you complain, the bank investigates. The 2026 framework is more proactive. The system tries to predict problems and slow or stop them before the damage is done. That's good for you as long as you understand how to work with it. What you should actually do about holds and monitoring. 3 simple mindset shifts will help a lot. Don't panic at the words funds on hold. A hold is not automatically an accusation. Often, it just means the system is doing what it's required to do under the new rules. If you expect an unusual deposit, build a small buffer if possible. Big bonus, large refund, one-time transfer. Try not to schedule major bills to hit right on that edge. A small cushion can prevent fees if the deposit clears a few hours later than you expected. Check your account regularly, but efficiently. You don't need to obsess. A quick scan a few times a week is enough to make sure deposits posted, no strange debits appeared, and nothing looks off. In this new environment, awareness is one of your best protections. Now, monitoring is only one piece of the 2026 changes. Let's talk about 2 other upgrades that directly affect how you spot and stop fraud: clearer labels and earlier intervention. Clearer transaction labels, less confusion, faster reactions. You've probably seen this before. You open your banking app and see something like XYZP 8872 9CA. You have no idea what that is. Is it a subscription, a random online purchase, fraud, a free trial you forgot about? You end up Googling weird strings of letters, digging through email receipts, or just hoping it's not a scam. The confusion doesn't just waste your time, it slows down fraud detection. Under the updated standards, companies using ACH are required to use clearer, more standardized transaction descriptions. Payroll must look like payroll. Purchases must look like purchases. Refunds and transfers must be labeled in an understandable way. Why this matters? You can glance at your statement and know what you're looking at. It's easier to spot something that doesn't belong. Fewer transactions live in that confusing gray area where you're not quite sure. And over time, this helps the bank's systems too. Standardized labels mean algorithms can classify behavior more accurately, which should reduce false alarms and unnecessary holds once your patterns are known. But what if something is wrong? That's where the next change matters. Stopping unauthorized debits earlier. In the old system, if you spotted a suspicious ACH charge while it was still pending, your bank often couldn't really help yet. They'd say, "We have to wait for it to post before we can dispute it." So you'd sit there watching the pending charge for days, knowing money was about to leave your account and being unable to stop it in time. Only after it posted could you file a claim, start an investigation, and maybe receive a temporary credit. Meanwhile, your balance was lower, which could trigger overdrafts and missed payments. The 2026 framework changes this dynamic. Banks are now allowed to initiate a written statement of unauthorized debit, a WSUD, earlier in the process, in certain cases, even while the transaction is still pending. In plain English, if you catch an ACH debit you didn't authorize, your bank has more flexibility to start blocking or reversing it before the money fully leaves. That doesn't mean every fraudulent transaction will be stopped in time, but the earlier you notice it, the earlier you report it, the better your chances. For people living paycheck to paycheck, this is huge. Losing a few $100s for even a few days can have real consequences. Early intervention helps protect not just that one transaction, but the chain reaction that can follow. This becomes even more important with the fastest growing category of fraud, social engineering scams. When you authorized it doesn't mean you're to blame. Not all fraud involves hacking into your account. Sometimes the criminal never touches your login at all. They just manipulate you. These are social engineering scams. Someone calls pretending to be from the IRS. Pay right now or you'll be arrested. Someone pretends to be your bank's fraud department. Your account is under attack. Move your money to this safe account immediately. Someone calls claiming to be a grandchild in trouble. I need bail money right now. Don't tell anyone. In these cases, you authorize the payment because you were lied to. Historically, banks often treated these as authorized transactions. Since you technically approved the transfer, recovery was much harder, even when it was obvious you'd been manipulated. The 2026 updates start to shift that thinking. There is now clearer recognition that authorization obtained through deception is not the same as real consent. Banks are being pushed to take these cases more seriously, document circumstances better, coordinate more closely with other institutions to try to recover funds. This still doesn't guarantee you'll get every dollar back. Timing is crucial, especially with instant payment systems like the Federal Reserve's FedNow, where money can move between banks in seconds 24/7. But the regulatory posture is changing from "you press send, so it's your fault" to "we need to look at what actually happened here." That makes how fast you react even more important. If you, or especially an older parent or grandparent, do a lot of business over the phone, this is critical information. A single high-pressure call combined with an instant payment can empty an account in minutes. Knowing that banks now have more tools and more responsibility in these cases is important, but it's still far better to avoid the scam altogether. We'll come back to concrete steps you can take in a moment. Government benefits, paper checks, and digital risk. Another big 26 shift affects retirees and anyone receiving federal benefits. Paper checks are disappearing. The U.S. Treasury has been moving aggressively away from sending physical checks for Social Security veterans' benefits, many other federal payments. Why? Because mail theft has exploded. Criminals steal checks from mailboxes, chemically wash the ink, rewrite the check for thousands of dollars, and cash it. The response? By 2026, the federal government is pushing strongly toward electronic disbursement only, direct deposit into a bank account, or funds loaded to a government-issued prepaid debit card. From a security standpoint, electronic is safer than a piece of paper in a mailbox, but it also pushes millions of people, many of them older, into fully digital banking whether they're ready or not. If you or someone you love is in that group, a few things become non-negotiable. Make sure the correct routing and account numbers are on file. Verify that the benefit shows up on the expected date. Watch for unusual withdrawals or missing deposits. The set it and forget it mindset doesn't work as well in a faster, fully digital system. You don't need to become a tech expert, but you do need a simple habit of checking. Faster payments, faster overdrafts. Instant payments have another side effect most people don't think about. Overdrafts can happen faster too. In the old model, transactions often processed in predictable windows. A purchase made late Friday might not post until Monday. Sometimes a weekend deposit could quietly land first and save you from a negative balance. As ACH speeds up and instant rails like FedNow gain traction, that timing cushion shrinks. Money leaves your account faster. Money sometimes arrives faster too, but the margin for error is smaller. Imagine this. Your balance shows $500. You're expecting a $100 and $200 direct deposit today. You schedule your rent for the morning, assuming the deposit will be available. The deposit is flagged for review for a few hours under the new monitoring rules. Your rent pulls before the deposit clears. Now your account goes negative. Depending on your overdraft settings, either the rent payment is declined, no overdraft fee, but you may owe your landlord a late fee, or the bank pays it and charges you an overdraft fee, often around $35. There was a federal push to cap overdraft fees at $5 for large banks, but Congress blocked it. Some states, like California, have moved to limit certain overdraft fees at specific institutions, but big national banks still mostly set their own rules. With timing getting tighter, you have to take a more active role. Check whether you're enrolled in overdraft coverage. Ask which transactions it applies to, card purchases, ACH, checks, etc. Decide whether you'd rather have a transaction declined than pay a fee. Many people don't realize they can opt out of certain overdraft coverage. For small card purchases, a declined coffee is often better than a $35 charge. Most banking apps also let you set low balance alerts. In a faster environment, those alerts are incredibly valuable. A simple text when your balance dips below a certain number can give you just enough time to transfer money, delay a payment, or call the bank. Open banking, more control over where you bank. Not all 2026 changes are about risk and restrictions. One of the most consumer-friendly developments is something called open banking. For years, changing banks has been a headache. Update your employer for direct deposit change autopay info for every bill and subscription. Move savings. Close the old account carefully so nothing bounces. It's such a hassle that many people stay with banks they don't really like. The Consumer Financial Protection Bureau's new open banking rule changes that. Under this framework, your financial data belongs to you, not your bank. You can securely share and transfer it to another bank or approved app. Large banks have to start complying in 2026, with smaller ones following later. Practically, that means it becomes easier to switch to a bank with better savings rates or lower fees. Apps can connect to your accounts more securely without needing your username and password. Banks have to compete harder because you're no longer stuck just because moving is painful. This matters because savings rates are changing as interest rates fall. Overdraft policies differ widely. Digital tools and customer support vary a lot between institutions. Open banking gives you more leverage to choose who you trust with your money and to change your mind if they don't treat you well. Putting it all together, a simple checklist. We've covered a lot. Stricter monitoring of incoming and outgoing money, possible temporary holds on unusual deposits, clearer transaction labels, earlier action on unauthorized debits, stronger focus on social engineering scams, faster payments, and faster overdraft risks, more digital delivery of government benefits, new flexibility from open banking. So, what should you actually do? Here's a straightforward checklist for 2026 and beyond. Check your accounts 2 to 3 times a week. Look for expected deposits. Unfamiliar withdrawals. Anything that doesn't match your memory. Turn on alerts in your banking app. At minimum, enable deposit notifications, large transaction alerts, low balance alerts, new login or device alerts. Use two-factor authentication. Don't rely on just a password. A second code by text or app makes it much harder for someone to access your account. Understand your overdraft settings. Ask your bank, is overdraft coverage turned on? What does it apply to? What are the fees? Can I opt out for card purchases? Maintain a small buffer if you can, especially around tax refunds, bonuses, large one-time transfers. A little cushion reduces the risk that a brief hold collides with a big bill. If you or family receive federal benefits, verify digital details. Confirm direct deposit info is correct. Check that payments arrive when expected. Consider helping older relatives set up simple balance checking habits. Compare your savings rate once in a while. With open banking, there's less reason to accept a weak rate. If your bank quietly dropped your yield, you can look elsewhere more easily. Slow down whenever money is involved and someone is pressuring you. Banks will not ask you to move money to a safe account. The IRS will not demand payment right now by transfer or gift card. If you feel rushed or scared, hang up and call the official number on the back of your card or on the agency's website. None of these steps are complicated. Together, they dramatically increase your safety in a system where money and fraud move faster than ever. Banking in 2026 is more digital, more automated, and more connected than at any time in history. That brings real advantages: stronger fraud detection, faster access to your money, easier switching between banks, better control over your financial data, but it also brings new responsibilities. You can't afford to be completely passive anymore. Small mistakes and delays can snowball quickly in a real-time system. The people who handle this transition well won't be the ones who panic. They'll be the ones who pay attention early. If this breakdown helped you understand what's happening behind the scenes with your bank account, make sure you're subscribed to Borderless Pathways so you don't miss future updates. Financial rules usually change quietly. The earlier you understand them, the more control you keep over what actually matters: your paycheck, your savings, your bills, your stability. In a system that's moving faster than ever, staying informed isn't a luxury anymore.